Z Limited is engaged in the manufacturing of shoes, and the statutory auditor of the company wants to reasonably ensure that only inventories recorded in the financial statements are exclusively owned by the company and do not include any inventory that belong to the third parties, but include inventories owned by the company but lying with the third party. Advise the auditor what audit procedures he has to apply. Now here, if you see, the auditor wants to ensure that entity has a, what you can say, the right over the asset, right over the inventory. They should not include inventory which belongs to the third party, and they should include the inventory which is lying with the third party but belongs to the entity, that is Z Limited. So here, first of all, auditor has to perform analytical procedures. He has to compare the current year inventory with the previous year, current year inventory with the industry average, okay, our budgets. He has to compare with the prior year. So comparison test has to be done by the auditor. He has to do a trend analysis. The auditor has to compute inventory turnover ratio. So what is inventory turnover ratio? Cost of goods sold divided by average inventory. And he has to perform a vertical analysis, that is inventory to total asset, what is the ratio. And he has to see the budget with the actual. What is the budget with the actual? He has to do a comparison of the same. That's the thing here. Further, the auditor has to look into the non-financial information such as the weight of the inventory, the measurement of the inventory, okay, and physical count of the inventory should match with the ledger total. Whatever ledger total or inventory you're showing, physical count should match. You should reconcile the same. Similarly, the inventory which is lying with the third party like transporters, warehouse, port authorities. So auditor has to reconcile that inventory which belongs to the client but it is lying with the third party. That's the thing here. And goods which are received on consignment basis, that they have to segregated, because here the client is acting as a consignee. So it belongs to the consignor. He should not include the same thing. Further, auditor, what he has to do, he has to check the purchases, he has to check the shipping documents, the receiving reports, the warehouse records, the inventory records has to be checked by the auditor. He has to check whether any transaction has been omitted, that has to be checked, and check the arithmetical accuracy of the inventory listings, okay, inventory listing, and examine the physical inventory with the what is mentioned in the records, the perpetual records, the ledgers, these things to be highlighted here. Okay, so these are the steps to be taken. Apply analytical procedures, apply non-financial, check the non-financial information like weight, measurement of inventory, examine the purchase and other documents, actually purchase and sales. You have to check the document, you have to see that, because that has an impact on your quantum of inventory. Is there any transaction omitted? You have to check the physical inventory with the perpetual record, physical inventory with the ledgers. Then also any inventory which is held by third party has to be included. Okay, and which goods which are received throughout the consignment basis, that has to be segregated or excluded. Okay, this is the thing.